Hey guys, hope everyone's doing really well today or tonight. I want to make a quick video on using trust and company structures. Now, this is something that has, I guess, recently popped up for me, especially because I'm starting to kind of, really build up that real estate portfolio. And using trust and company structures is something that, I guess, for as a primary use is really good for asset protection. There's some tax advantages like being able to do distribute income to different areas apart from yourself. Maybe it's to a company, maybe it's to another trust, maybe it's to another individual. But there is also I guess, less spoken about aspect of using trust and company structures, and that's the ability to kind of, I guess, protect your serviceability when it comes to purchasing properties and getting a mortgage on properties. Inevitably you will kind of hit a limit, especially if you're on a salaried employee. So using these structures can kind of help get around that potentially. And yeah, we'll get into exactly what it looks like and how it might apply to you. Now, what are trust and company structures? So, very simply said, they are legal entities often used for investing in assets like property, shares, or businesses. They are not only for real estate, you can invest in the stock market through one of these structures. You can also purchase other businesses or other assets. It's not only just for property. So, yeah, it's really flexible in terms of how you can use to invest. Now, many people, and rightfully so, invest in their personal name. It's easy, it's quick, it's simple. It's obviously the first thing we have before we have to establish any other legal structures. And look, this is fine, but sometimes these structures can be better, especially if you really want to kind of optimize over time and really grow that your wealth. I guess past the point to where you could in your own personal name, or maybe preserve wealth or potentially I guess save on fees and other costs as well, like taxes. And yeah, like I mentioned before, I guess their primary source, not source, sorry, their primary reason people use them is for asset protection, tax advantages, and being able to distribute income differently. For example, to your wife, to potentially a husband, to potentially adult kids, maybe not your adult kids. So there's lots of different ways you can do it. Maybe it's even to another trust or to another company or to another business. Now, depending on your strategy, you can use either a company or a trust, or you can use both together. Now, in real estate, like I mentioned earlier, investors use, and this is for the strategy I was mentioning before, preserving borrowing power. Many real estate investors use a company and discretionary trust structure to reach unlimited borrowing power. That's not really the case, but it kind of just preserves in a way that you can kind of keep borrowing. Essentially, if put that debt out of your personal name and you've done it in a way that the bank doesn't really need to look at it, then it kind of gets disregarded. Especially if it's positively geared and it's kind of self-sustaining and you don't have to contribute any money to it. Generally speaking, that's a really good position to be in if you do want to maintain your borrowing power. Now, this does get quite complex. So obviously, you do need to speak to a professional, either a financial professional or an accountant or someone in the field of tax and trust structures. But you actually can create a trust and a company yourself quite easily. But there's just so many ifs and buts. There's lots around, the trust deed and you know, there's just it can get quite complex. So don't be surprised if you're spending, say, 2 to 3 grand to establish a structure like this per property or per couple of properties. Now, this might sound really exciting, but is it right for you? A trust or company is right for you. Now, it is highly dependent on your goals and life circumstances. Don't listen to people that just say automatically, "Oh, you need to invest, through a trust or a company because it just makes the most sense." The reality is that many people, if not all, will invest through their personal name initially, and a lot of people get really far doing that. It's less complex, it's easier, it doesn't cost as much. So that's really interesting to some people. And then for others, it makes a lot of sense to establish a structure like this, but not all the time. So take that, consider that. Um, And yeah, look, this isn't just for property. Many people in real estate enjoy leverage or offsetting land tax using these structures. I did mention that it is really great for preserving that borrowing power, but I mean, there are other advantages as well. Like, you get in some states you get a new land tax threshold. Other states not so much, but that could be really interesting. I know New South Wales currently kind of, I guess, they account land tax per trust and company structure, and then also in your individual name. So you can kind of essentially get a new land tax threshold each time you create a new structure, which is really interesting. An interesting point here as well is that some professionals won't suggest you do anything until you've proven that these structures could work. I forgot who it was. Someone named Jono, I believe, if I'm not mistaken. Someone who's really successful. I believe he's in his 40s, and he's a professional accountant in Australia. But his rule is you purchase 3+ properties in your own name, and then you've kind of proven that you are really interested in investing, and you kind of really want to take this further. But until then, some structures can be really costly. They can be time consuming. They can actually be preventative in terms of getting property because there's more documentation and maybe some conveyancers or realtors don't want to deal with that, or some banks don't want to deal with that. So there's that. And like I mentioned, they are expensive and they also require annual tax returns. So it can eat up profit. It's also they also don't really give you the same negative gearing advantages that they would in your personal name. So there's just lots of different pros and cons to it. There is no one size fits all in this case. It really is just dependent on your situation. Now, the documents I'm referring to here, right, is for example, your title deed or your trust deed. These can be really big documents. If you buy cheap product online that isn't kind of tailored to your situation, or kind of, I guess, misses out on a lot of things, you might be in trouble because it may come back to bite you later on in life. It might be cheap at the time, but sometimes cheap doesn't pay that well, especially when it comes to housing millions and millions potentially of dollars, and having problems with that. Maybe that's not worth it at that stage. Now, a couple tips and considerations for these structures. First and foremost, always get professional advice. For example, property lawyer or a financial lawyer or financial accountant, financial planner. It really does work well for some people. Some people have built many tens of millions of dollars worth of property through these structures. But for others, they end up opening it, they don't use it, or they decide maybe property is not for them, and then they have something here that's cost them 3 grand to start up, and then obviously over time they've had to do annual returns and they've had to do whatever else, and then there's the cost of closing the trust. So it's just sometimes it's a waste of time for some people. You don't want to get yourself in that situation. You do want the ROI to make sense. I think with trusts and company structures, there's obviously different capital gains tax thresholds and different tax rates, and it's just very different. There's also land tax, like I mentioned. Some some um, some trust and company structures don't have a threshold. Some have a higher threshold. So it all just depends on the state. But this could be interesting. Depending on what you're investing in. There also is, more documents to process, more audits to do, more people to talk to. It's just more things, more headache potentially. But look, if that's the thing that kind of allows you to keep building on your property journey and doing more, then maybe it's worth it for you. You do also, if you are investing in property, for example, you do want to make sure you're set up to purchasing the assets, if applicable. What you don't want to do is, for example, purchase something in your own individual name and then transferring it later on into the trust or the company structure. Normally, if not stamp duty, when it comes to property, there would be capital gains involved, and then you'd have to kind of transfer that over. It's just more of a headache than anything. So ideally, if you can organize the structure you want now and then kind of figure out what you want to do later on, that could work really well. But again, a lot of people end up investing in their own name over the long run, and that works just well for them. And the last point here is, look, if this is done correctly and at the right time for your situation, they can be very powerful in wealth creation. Like I mentioned, some people are making, not making, but they're housing tens of millions of dollars to these structures in real estate, real estate, crypto, shares, businesses, whatever it is. So it could be really interesting for some people, not for everyone. I think it really works really well for those who are dedicated to investing and really squeezing everything out of what they can do and building something really special. So yeah, hopefully you guys have really enjoyed the video. This was really interesting for me, and I've learned a lot. And potentially this is something I will do in the future. If you guys have any questions, let me know down below. But otherwise, I'll see you guys in the next one. Peace.